Let's get practical now and talk about possible trading strategy options in and amongst these turning points on the 1, 2, 3 top. Well, of course, if you have established that you have a number 1 position unfolding in a chart reversal pattern, if you're a position trader who had been on the long side of the market up till now, if you're not already out or scaling out, you really ought to be looking for some exit points on your open long positions. If you wanted to, you could take the attitude of waiting for the number 2 position to unfold and then wait for price to bounce back up again. You could do that if you felt confident. But it's probably most prudent to at least start scaling out if you suspect you're looking at a number 1 position on a 1, 2, 3 top. So from a more conservative point of view, how do you want to trade these patterns? Well, particularly if you're a position trader, you would most likely want to wait for confirmation of the number 3 position to start taking fresh shorts. You're not going to take very many long position trades throughout this pattern unfolding. They're just not going to be very long-lived for you, and you're going to have to react more quickly than usual. So again, when we suspect a 1, 2, 3 top, then we're really starting to drill down to lower level time frames, looking for setups to the short side. Now, a riskier approach to the 1, 2, 3 top is to simply try to scalp the moves from the number 1 down to the number 2 position, the number 2 position up to the number 3 position, and then once we have confirmation of number 3, you would change your trading bias to more to the short side as per position trading conservatively after that point. Now, if you're just simply surfing pivots all day long, of course you can go up and down however you please, but just know that the highest probability trades after the number 3 position and the onset of a down move are going to be short positions rather than long positions. So just generically, those are some trading strategies you might want to consider when you see a 1, 2, 3 top unfolding. On this chart, what we're doing is we're starting to drill down now. Okay, so to the left here we have the time frame roughly that coincides with the establishment of the number 1 position on the daily chart. That's this area over here where my cursor is hovering. We then see price breach the 200 period EMA to the downside on this 3-hour chart. Broken support, price comes back, tests it as resistance, and we get 1, 2, 3, 4 or 5 hits of resistance against this now downsloping 200 period EMA. What we would do at this point is drill down successively further. We're looking for a confluence of really clear signals to trade this thing to the short side, because again, what we're doing with this is we're looking to scalp the downwards action from the number 1 to the number 2 position that we read off the daily chart. So price testing broken support as resistance, and you can see what happens. It falls off. The trend on this level is now down. We can see what happens again. Price rallies, doesn't even touch the 200 period EMA, has a real tough time rising even that high. Again, what we would do is we would drill down further to a 1-hour chart, and I virtually guarantee you that you would see a pretty strong confluence of short signals setting up here, concurrent with a little bit of congestion below the downsloping 200 EMA. Okay, so what these are counter trend rallies on the 3-hour time frame, and we're going to drill down even lower for opportunities to sell these rallies. This is the setup. It's not necessarily the entry point. But now let's take a look at what MACD is doing all throughout this cycle as we reach down from a number 1 to a potential number 2 position. We've got all these crossover events happening. To the left, we have a nice bearish crossover, which is validating the subsequent down move. We have a trickier crossover situation here. We have a bearish continuation crossover down. You might not get a lot of comfort out of this kind of a signal, and actually it comes kind of late on this time frame. But what again this points to is the need to really start drilling down. When you see a setup materialize like this, don't wait for the signal on this higher time frame. Drill down to a lower time frame. Price rallies up. Once it breaks down again, over here we have another bearish crossover on MACD. But again, on this time frame, it's coming too late to act on. by the time we've got confirmation, price is already over here and there's not a lot of downside left. So you want to drill down to a 1 hour time frame when you see enough candles here to give rise to a suspicion of selling the rally in a downtrend. And then ultimately we know with reference to the daily chart that the number 2 position is established more or less in this time frame. And we actually could have drawn a horizontal support line on MACD and a falling support line on price, giving us a positive divergence signal. And then subsequently MACD crossed over bullish, and that was happening all in the context of a number 2 position unfolding. So our short scalping opportunities from this number 1 here to this number 2 here relative to the daily chart, they've pretty much run their course by this point. So you really have to, again, watch those setups and be on top of them at all times and sell the rallies in a downtrend. Don't sell this. This is not a rally. This would get you stopped out. Sell this and sell this. And be aware of what's happening on the daily chart because you know that you're out on the short side somewhere in this neighborhood and are flipping your bias then long, assuming you are scalping these turning points at all. So that just starts to give us a flavor for drilling down relative to the daily chart pattern. What we're going to do now is look at the concept of histogram waves, which we mentioned earlier, and how we can read them in context of a potential 1, 2, 3 bottom reversal pattern. We're going to look at everything else going on in this chart as well to put it all in context. So we've established a possible number 1 position by the time that we get this very sharp angled Tom DeMark style supply trendline break over here, validated by a very clear bullish crossover on MACD. There was a spinning top ending the run. There was a sharp angled supply trendline break. We know that this down move is temporarily finished. Temporarily. We then put on our Fibonacci tool, and we can see what happened is that after price broke this trend line, it wasn't ready to go all the way up yet, because when price falls off this sharply, it's not just going to turn on a dime usually and just go ripping off in the other direction. The market really needs to be confident that a bottom is being hammered out here, and I would suggest a simple spinning top is not enough. So the market retraces perfectly to the pip to the 50 Fibonacci level. We can then see as price drifts down from there, there's reason to believe a number 2 position opening up. We then can draw a common sense trend line on subsequent highs of these candles. Price respects this supply or common sense trend line heading down. And then what we're going to do is we're going to look at the histogram waves and put them in context. Okay, on this initial move down, you can see there was a really solid wave, a curve, a group, a cluster, whatever you want to call it. Very punchy, deep red histogram bars. And the way you can sort of interpret these things very simplistically, yet effectively, is to think of them as analogous to momentum. So there was a lot of initial momentum to the downside here, and we got lots of deep red, angry-looking red histogram bars. Lots of red ink here. This thing's coming down with a lot of conviction. So price then came up to the number 2 and drifted lower. Take a look at what happened subsequently. Remember, we're hunting for the possibility of a number 3 position. Look at the histogram. As price drifts lower from this number 2 position, testing old lows off to the left here, there's just no momentum. This wave of histogram bars, this red wave here, it is virtually insignificant in size compared to this initial wave marking the move down to the number 1 position. Think of this again simplistically as momentum. Does this look like a lot of screaming, angry, bearish sentiment here? Compared to this wave, no, it does not. There's just not a lot of conviction to the downside. There's not a lot of momentum. The market is not pushing hard for lower prices at this point. So you can kind of read these groupings of histogram bars in relative terms, and that can help you form a perception as to is there any momentum behind this down move or not. And once we get this common sense supply trendline break happening here, validated by this histogram bar painting in green on the opposite side of the waterline, confirming the crossover on MACD. This histogram wave is finished. So for the time being, it looks as though there's going to be no further testing to the downside. And if that's the case, we do have a number 3 position. Actually, I've got this position not quite perfectly. This is the number 3 position right here, this swing low. And so from there we can see the market is free to head up. So let's just recap this. We saw a secondary histogram wave, this shallow one here, and it was waving much shorter or shallower relative to the waterline as compared to the histogram wave corresponding to the initial move down. So that we can interpret as proof of a successful test. There's going to be no further testing to the downside. The market can move up, and that's what it did. Actually, the price projection that we could have used goes all the way back to the left here. We would have taken the low on the number 1 position measured up to the start of the move and project that up from the trendline break. If I had drawn that, you could probably eyeball see this, that that's exactly how far price went from here up to here, replicates the difference from here down to here. So I hope you find that interesting. It's a very subtle nuance, but look to your histogram waves in these 1, 2, 3 tops and bottoms, and let that help you establish some clues as to what's going on. Here's that nasty example of a fake out number 3 position, a sloppy bottom. And we're going to use the tool of MACD divergence as our secret weapon to help us get a leg up on the competition in terms of understanding what's going on here. We had a move down in price ending with this number 1 position. It bounced up and formed a number 2 position. We don't know this at the time it happens, of course. We have to let subsequent closes tell us. So we don't know it's a number 1 position right here, of course. We don't know probably until up to about here, by which time we have a number 2 painting in. But regardless, somewhere over in this area here, we have a belief of a 1 and a 2 as price is drifting down. Now, you can see, again, following up on the previous chart, the histogram wave here on the move down actually is not really that much shallower than this initial one. It's pretty close to the same size, actually. Not quite, but this doesn't look notably weak as price starts to move down from here. It isn't that sort of initial sharp wave down followed by a weak wave down. It's something different. Price takes out this number 1 position, and if you're just eyeballing that simplistically, you would say, okay, that's got to be pretty bearish. But the number 3 position took out the number 1 position, and what we can do is connect those 2 swing lows with a falling support line. What's going on with MACD? Well, we've got a swing low almost directly beneath it. We've got that attaching back to a lower swing low. That gives us a classic bullish or positive divergence. And in fact, the histogram comes to our aid as well. We can draw a divergent line on histogram and MACD to price. So the histogram wave is a little shallower, the second wave down, not a lot, but it's the divergences that really flag this as being a wrong way move. So if you're short here, you made the mistake of jumping in, you'll want to get out. Oops, we made a mistake. We want to exit this position right away. But if you're not short, fortunately for you, you have the opportunity to wait for these divergent signals to confirm that this is a false lower low. So we can flag that as a number 3 and a sloppy 1, 2, 3 bottom. We subsequently had some funny business going on over here. The market rose up and then came right back down to test this area over here. This is more like a 1, 2, 3 bottom right here. So it's almost like back-to-back 1, 2, 3 bottoms, a sloppy 1, 2, 3, and then a standard 1, 2, 3. But in any event, with these divergent signals in the background and the successful 1, 2, 3 bottom, you could take this as an opportunity to trade the long side. So positive divergence on both MACD and histogram to price confirm a number 3 position of a sloppy bottom. And if we don't have signals to get in long right away, we're certainly thinking long and looking for those signals, drilling down to lower levels as required. So that's how divergence can help us navigate our way through 1, 2, 3 bottoms. That brings us to the end of Module 7. In this chapter of our exposition of MACD, we looked at the 4 different conventional 1, 2, 3 top and bottom patterns. We discussed 3 primary applications for MACD, how it can help us navigate our way around the turning points within these patterns, including crossovers, divergent signals, and histogram waves. And we showed how we can use these together with other indicator events to help confirm the turning points in the pattern, and then we outlined some simple strategies for how to trade 1, 2, 3 patterns using MACD. So for example, if you're a position trader waiting for the confirmation of the number 3 position, or if you are an intraday trader, you can definitely scalp the moves from 1 to 2 to 3 and so forth. So I hope you found this helpful. We're now going to move on to the last module in our course, where we're going to just basically tie together all these various concepts we've gone over with some top-down trading examples.